China moves to stabilize the yuan. The central bank setting the daily fix stronger than analysts expected, easing concerns about a full-blown currency war. The PBOC setting its daily reference rate at just above 7 yuan to the dollar, although this was the first time since 2008 that the midpoint was set weaker than 7 to the dollar. It still beat average estimates of about 7.01, according to analysts polled by Bloomberg. Joining us now is Eddie Ghabour. He is with KeyAdvisors Group. Eddie, it is really interesting to see how much the market has come back. Is it really all about the yuan?
It's about that. It's also about trade, the currency wars. There's a lot of outlying factors right now. And I don't think investors should look at this bump up as continued running up. I've been bullish for a long time, but I'm becoming very cautious right now. I think this is an opportunity with this bounce back that we've gotten after Monday's sell-off. For anyone that was overweight equities and Monday making their stomach turns, that they should probably start taking some profits right here, because I believe this volatility that we saw on Monday is not going away anytime soon over the next couple of months.
So time for investors to start taking profits. So where do they go?
So right now, look, there's nothing wrong with holding cash in a portfolio and waiting for that market to correct and go back in. I'm not saying or advising to investors to get completely out of the market, but based on what I've seen, some individual investors have been way overweight equities riding this terrific run up we've seen. And I think right now holding cash is not a bad thing. So that way you can take opportunities and buy the dip, because I think we're going to get some very nice opportunities like we did in the fourth quarter of last year.
Let's talk about some of the moves we've seen in the Treasury yields. We saw the 10-year yesterday move below that 1.6 mark, hitting a 3-year low. And yet, you look at the number today, 1.75. What is the bond market telling us?
Right now, keep in mind, we've had an inversion of the yield curve on the 3-month and 10-year Treasury for over 3 months now. So the bond market definitely is telling us that there's some underlying outliers out there that the market is not pricing in. My concern right now is there's not enough fear in this market. The bond market's telling us one thing, that there's a potential slowdown coming, and the stock market is completely ignoring it. And to me, that is another signal as to why it may be prudent to be a little bit more cautious on the equity side, adding cash, and maybe even being a little bit more defensive on your equity positions.
What do you think is leading to that complacency?
Because every time we've had a short-term drop, the market has come back very quickly. There has not been that real test like we saw in the fourth quarter. So as an investor, you become complacent. I mean, take a look at Monday. Okay, Monday, you thought the world was coming to an end with a 900-point drop. And here we are 2 days later as if it never happened. So everyday investors kind of get to the point where they feel, oh, it'll just come right back the next day or two. The problem is when you have that complacency in the market, that's when you're a perfect setup for a collapse like we had in the fourth quarter. And that's what my concern is as we head into August and September with this trade issue that we're dealing with right now, as well as what the bond market is signaling.
I've heard you say multiple times already to be defensive, holding cash, one play, you say, in terms of strategy. Are there potential opportunities maybe you think that investors are overlooking right now?
Look, with the 10-year dropping the way that it is, I think it becomes more advantageous from an equity standpoint for people to start looking at some dividend plays. One thing that you'll see when you have these broad-based sell-offs is you'll be able to pick up some equities that have a really nice yield, maybe even doubling or even more than doubling the 10-year Treasury. That income stream helps offset some of the volatility that investors can play. So when we talk about defense, we're talking about companies that have good cash flow, pay a handsome dividend, and allows you to wait out this volatility. I just don't think investors should be fully weighted in equities right now with all the uncertainty. I feel like in the short term, there's a lot more downside than upside in the market.
And finally, Eddie, going back to what you said in the beginning, what's driving some of the positive sentiment we're seeing in the market today, that being the PBOC fix on the yuan to the dollar coming in stronger than expected. What is the assumption you're operating under right now?
I'm under the assumption that this is going day by day. I do not think that they're going to just roll over and come up with an agreement. Until there is a verbal compromise, the market is not going to be calm. So I think this is just a one-day event that made investors happy for the day. But it'll be interesting to see how we finish at the end of the market today. Are there going to be people taking profits and watching the market come back down, or are we going to see acceleration? Either way, I firmly believe that there's going to continue to be more headwinds in the short term with trade that's going to disrupt the marketplace.
And Eddie, it looks like we are already seeing the market coming back down just slightly, now up about 280 points for the Dow. Eddie Ghabour, appreciate your insight today.
Thank you so much for having me.